Tom Metzold, the Muni market seemed to like Janet Yellen's dovish talk last week. What did you think?
Well, part of the reason they loved it was because we had underperformed treasuries throughout most of February and the beginning part of March. And this was assurance that rates weren't going to go up as fast or by as much as people thought. So the muni market finally started to track treasuries a little bit. Despite that, we're still trading in excess of 100% of treasuries in the 10-year part of the curve, particularly on the 30-year part of the curve, where munis are yielding more than 110% of treasuries. Sort of crazy when you think you get more income on a bond you don't pay taxes on than a bond you do pay taxes on.
And what kind of munis do you like? Do you like GOs? Do you like revenues at this juncture? What are your favorite ones since you're still looking?
We've always been bigger fans of revenue bonds versus general obligation bonds, particularly the essential service revenue bonds, your water and sewer, your electric utility. We saw that in Detroit, where the Detroit water and sewer bonds got paid off at 100 cents on the dollar and the GOs took a haircut. So we think that is an example of why you stick with revenue bonds.
Let's talk about credit quality, and we'll stay in the Midwest. A lot of worries about the state of Illinois right now. The governor's negotiating with the pensions over how much they're going to pay out. Could Illinois become the next Greece?
Illinois won't become the next Greece, but Puerto Rico may be. And sticking with Illinois for a second, they've got taxing power and ability. It's the Chicagos of the world that are going to get less revenue passed down to them from the state that has to worry about issues, particularly when pensions and healthcare costs are consuming a greater portion of their budget every year.
Now, you also run a high-yield muni fund over at Eaton, Vance. Should investors stretch for yield right now, even in the muni space?
I think that the high-yield muni market had one heck of a run. It had tremendous amount of flows into that arena. But a lot of stuff that's coming these days is questionable in terms of its risk-reward profile. So I'm a little bit less confident or less sanguine about the muni market or the high-yield muni market. There's still some value there, but you have to be very careful and pick your spots.
And then finally, we're heading into tax day, April 15th. People are gathering their stubs. So once again, a reminder as to the real reason why people want to own munis.
Well, at Eaton Vance, we actually do a survey that talks about the most important issues to investors, and income, volatility, and taxes, along with growth, are those four areas. Well, income and taxes are two things munis do really well on, particularly when they're yielding more on a taxable equivalent yield basis than any other taxable alternative out there. And they are exempt from federal income taxes, the Obamacare 3.8% surcharge, and if you stay with AMT-free munis, you can avoid the alternative minimum tax, which is actually capturing more and more people right now. So munis solve a lot of problems for people in that regard.
All right, thanks a lot, Tom.
Thank you.
And thank you for watching The Street.